Oh, good evening, everybody. My name is Daniel Young. Sorry for the choppy video. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back with more strategy on investing into the market at large using closed-end funds to improve our investing. The disclaimers, this is an unedited video, as you've seen with the shaky screen. So who knows what else you'll hear or who knows what else you'll see in the background as I film these in my house. I'm not a financial advisor. I am a strategist. I'm a financial strategist, but I am a strategist. And I don't speak like the herd. I walk in limited company and sometimes I walk alone. So if this video seems choppy, that's not my goal. Um, I wrote my script and talking points yesterday, but that's changed into today even, just with stuff going on. And my goal is always a smooth presentation, but it doesn't always happen. So if I miss on this video, I apologize. Um, so where are we after last week? I mean, the market finished a little down overall, and there remains widespread signs in the economy at large that there's a lot going on, even though it doesn't seem like it. There's a really deep undercurrent in addition to what we see on the surface, and that it still seems like we're on the edge of a recession where it's stagflation, you have rumors of layoffs, store closings, and then just changing metrics on inflation. And all of that points to a stagnating or even uh, significantly slowing economy. And involved in all of that is you have this election cycle that's also playing a part in market jitters. There's one nominee dominating the polls and controlling the narrative, and the news is holding back the facts from the masses. And quite honestly, the same news groups and their advisory services aren't helping. The market's jittery and it's uncertain because the people watching the news and listening to the herd and list the people watching the news are the herd, and they're getting their advice from the same people that withhold information from them. So they're wranglers. And if we imagine the herd as sheep, the sheep wranglers, those guys are pushing some narratives, none of which are helpful. And it makes me wonder where their callers, where the sheep guiders are really investing. I mean, the herd listens to those talk show circle junkies, the people that give this crappy advice and then they just hop from one show to the next and they say the same thing regardless of the network they're on. And they pump fear into the masses and they steer the herd away from where they're investing. So you have the herd investing someplace and you have those other guys investing somewhere else. And it always makes me wonder. I mean, it's a very crafty game, right? Like if you and I did it, which we wouldn't, but if you and I did it, it would be so like if you own a specific bond fund and you want more people to buy the bond fund, so the bond fund increases in cost, you would tell people that it's a really great deal and they know what they're doing and that's the place to be. And the herd hears that and they flock to it like seagulls and free food. And in the background, all the funds that just don't get a lot of notoriety slowly decrease in value because of interest, right? It's all supply and demand. So you have these increasing shares or just a lack of interest. And then you can scoop this amazing deal. And then when you're ready, you steer the herd towards that. And then you raise the price on it. You can either sell it, right? Or just raise the price indefinitely. And you're always at least 2 to 3 steps ahead of the herd so that you're scooping this amazing deal and then sending the herd to invest in it. And that it just doesn't sit well with me. Um, Quite honestly, it's I don't speak like the herd, and I don't speak like the people advising the herd because um, I'm even when I was new to this, it there's there's always a level of self-doubt. You can be as confident as you want to be. There's always a level of self-doubt. And I feel it most when I buy something, especially when I buy something nobody else is buying. Um, but it's quite okay to walk in limited company. It's quite okay to walk alone because it just means that you're not listening to the herd and you're not listening to where they're going. Where they're going matters in a sense that you don't want to be in the same place they are. But it also, where the herd is not where you are. So, yeah, I digress. Um, but the herd gets steered and they get steered on a lot more things than just investing. So I recently heard a story, really faulty deductive reasoning from a decent advisory service that said whether Trump wins or Kamala wins, both will cause an inflationary economy. And that's just crazy talk. Congress is currently spending almost 2 trillion more than what's budgeted. And either the CBO, Congressional Budget Office, either the CBO is failing in their job to nix new spending without appropriate taxing, or Congress is hiding a lot more taxes. Think about that. 2 trillion more in expenses. That's a lot of money going into the economy. And a big government doesn't stop spending. So it's really going to be more than that, right? So Kamala's plans include spending and more spending. Where's the money going to come from? Well, either Jay Powell's going to print it, either by obvious or quiet QE, or we're going to get taxed a lot more to fund that, which means less money for you to invest and less money for me to invest and more money for our government to spend on who knows what. But Trump's plan is it's a complete counter to that. He's already said, and Elon has accepted. He'll task Elon with government accountability and spending, meaning all of our tax money going to Ukraine and beyond, right? Who want to flood the USA with their prison inmates in the worst of their society, um, will lose funding. So Elon is tasked with gutting the government and our spending. Elon's um, talk today at New York, I believe there's 428 government agencies, and it's like another two groups added every couple days, and it's just like that's a lot of agencies, that's a lot of people, that's a lot of money, and the bigger government just keeps getting bigger. So he's tasked with cutting that. So if you gut the government and spending and you nix foreign aid, you can cut a lot of debt. You can cut a lot of spending, right? You can nix that extra 2 trillion real easy. Plus, you have Trump floating the idea of tariffs funding the government, not just nixing income taxes for firefighters and EMS and hospital, but nixing income tax for everybody. And that's a pretty bold thing. Like, why not? Why not consider it? Congress isn't going to on their own. Big government likes to spend, and it's not the government's money, it's our money. So think of how much money you lose in income taxes federally. I can't speak a lot about state income tax, but federal income tax, think of your tax bracket and then not sending that money to the government. That would put a ton of money in your pocket and give you more money to invest, more money to save, more money to push forward, more money to do something with than giving it to the government. That sounds awesome. But that's also not an inflationary budget. That's more money in somebody's pocket, which would spur the economy to take off because now you have money to buy the stuff that you need as well as some stuff that you want. That would cause some people to spend money. That would spur the economy, but that's not inflationary. So you really have, even the people that I trust, you really have to filter out what they say because not all of it makes sense. I did read an article that says the US Treasury is preparing for a Treasury sell off. That's concerning. I mean, if that happens, they would flood the bond market and they would drive prices down, which you could scoop a great deal, but that would drive down the bond market. Bond proxies like energy, utilities, even oil are the place to be right now. But that market is now shaky on a sell-off, and it's not bolstering everybody's perception of a strong economy. It's actually adding more fears to the possible recession. And on that, pundits or experts, and I'll put experts in quotes, experts, they continue to move the goalpost. I read an article from an expert that says he measures a recession by more than just a slow GDP. And that method isn't as technical a method. Wait. Slow GDP, two reporting cycles in a row, is what's being pushed as the gold standard on a recession. But now it's something different. I mean, that doesn't make sense. All it does is just say they've moved the goalpost and renamed something again. Since the current economy doesn't fit your narrative, you're just spinning it and twisting it and making it fit your narrative. I still think we're on the precipice for a recession. Call it whatever you want, spin it however you want. You cannot downplay the uncertainty surrounding our economy. And I said it last week, I'll say it again. If Kamala somehow wins, they will rename this slowing economy into a strong economy, right? Or they'll rename the slowing economy and recession into a strong economy and just change the wording. And if Trump wins, we'll have the worst recession in recent memory, unless the stock market immediately responds to his win and that momentum galvanizes growth and spending in the rest of the economy. But recession or not, we have to exercise caution. And really, right now, it's extreme caution in the current market. And I'm not, I can honestly tell you that as much as I read and as aware as I am, and I'll be honest, I don't get my news off the news. So as aware as I am and as informed as I am, and I am more informed than the average voter, I am more informed than the average person, that I'm not concerned. But all those new money investors and the herd itself, those people are more antsy than a recovering crack addict looking for a binge. Because even though I'm not part of the herd steers the economy and the herd steers the market. So it's good to be aware of them because you can anticipate what they're hearing from the news, but the trick is not following them. So we should strategize for a recession. We should be aware of where the herd is, right? But we should also hope for a turnaround. And I think that's very possible. In fact, I think both are possible, though they're not exclusionary to the other. And that we can still have a recession regardless of turnaround. We can still have a turnaround, right? But we could also have one or the other. So where's the best place to be right now? Bonds, utilities, energy. But that's where you should be. That's where you should invest. Bonds, I mean, at most, maybe 5 to 6 months ago was kind of the early cutoff on bonds. But really, if you bought bonds and I'm talking closed end fund style, if you bought bonds 2 years ago, even if the price has not recovered, you have raked on dividends. I mean, you have raked on dividends. And I can show you in our own portfolio for that. But the best place to be right now, really the most dogged corner of the market is real estate, which I deep dove on last week's video. But since last week's video, and more of what I continue to read, I've read at least 4 articles in the last week talking about how real estate is the place to be right now. And the only counter to that strategy would be the bond sell-off, because the bond sell-off would drive prices down. It would make the herd skittish, right? They don't want to lose money, so they would sell off and they would drive prices down further. And if you could scoop a really low price and a really amazing discount, that's worth consideration because we're playing a long game. We're not looking for quick money. Quick money's nice, but we're playing a long game and we want to use our current market and our closed end fund strategy to pick something we can either buy and hold, like lifetime buy. We can either buy and hold, or that we can buy and sell in relatively short fashion. So we can buy it, take our gains, sell it, and then swing that money or push that money forward into the next investment. And we have one fund for sure marked for that in our portfolio. In our Roth portfolio, we have two roller coaster funds, which riding the investment roller coaster sounds fun, but in the trough of it, it's really not fun. I mean, that we have two funds in the cash brokerage that I would love to sell at a specific metric, but it's just waiting for that to happen. My, hindsight is hindsight. You carry the lessons forward. So Roth portfolio, it's not a there's risk involved in the market. And yes, we have some risk built into our portfolio, I guess you could say in that regard. But a roller coaster fund is a lot riskier investment than the rest because you could hit an unknown tunnel and slide down just as well as you could take a quick turn and go up. So, I mean, the roller coaster is fun in that regards, in that it has a possibility of really going up, but riding the trough and that plateauing is just not fun. So the goal is in the Roth and in just in general, it's you keep the principal intact unless you swing one investment into the next, right? But then you retire on dividends. So you're not selling off your principal. You're not 4%ing it or 8%ing it or 12%ing it, which is a little more realistic. 4% inflation, 8% for you because you're not living off 40 grand right now. But you keep the principal intact and then you live off dividends or you supplement off dividends depending on what you got, right? And then you fund that or supplement that in the midst of your other retirement money. So yeah, I'll put this here. So last week I talked about HFRO and it being the best overall discount, and it remains that way. And I tracked it during the week, and we bought it during the week, and it remains the steepest discount. And it is real estate. It's all real estate. If you want more info on that, you can watch last week's video because me talking about it here is just going to really drag this video out. But the name of the game right now is caution. So is it amazing? Is it an amazing buy? Yes. Is it an amazing discount? Yes. Is there a lot of promise for the fund going forward? Yes. But the name of the game is caution. The market in the next 9 days leading up to election, and then even maybe the couple days after, is going to be anybody's guess of how it goes. We have our targets. We have our, and I'll get into that. I'll show you. Uh, we have we can thin out and use our strategy inside the closed end fund system to pick the best possible investments. But at the same time, the current name of the game is caution. You can scoop an amazing discount, but the market is jittery. So just understand your strategy, understand your comfort level, and then see where that takes you. So there we go. Share my screen. So this is the closed end fund master. It's all 412 funds. Everything's on closed end or CEF Connect except for the SAPA funds, which I still think is just the fun politics of investing. But and I've talked about that on other videos. What we're looking at is these targets. So One asterisk we track, two would be a dollar cost average, three would be a buy alert. And it's a buy alert in relation to that specific fund's discount, current discount, as it relates to the historic and 5-year discount. Or if it's a newer fund, how close it is to, we'll say like it's 1 or 3 year average, depending on fund. Um, the entire system gets updated monthly, which means next weekend it's due for an update. But of what gets updated weekly is purple, dark blue, light blue, and green. So we scale by discount, we scale by target, we get this really long list. And yes, we could look at all of these funds, but it's not a triple asterisk play. Like it's just kind of, we could talk about it, but it's wasted time because it's not going to make the final cut. These two are roller coasters. And I could pull up the charts, but I won't. But of where we are, I'll show these and then something else. So this is our actual portfolio. This is what we've bought and when we've bought and the metrics for each buy. That's our average price. That's our average price. They both, on average, uh, hover around 10. So ZTR sometimes goes higher, GLO sometimes goes higher. Ideally, we sell it at that price point, but we'll see because it's riding the roller coaster and it sounds fun until you're on it. But what I was talking about, bonds, I mean, that's a bond fund. We bought it low. It typically sits around 20. Uh, but since we've started owning it, so almost 3 years ago, we've collected $620 alone on dividends. Now, it's still below our average price. It was at and a little above our average price maybe 2 weeks ago. And you have the current bond fears, the current bond sell-off fears, and it's dropped a little bit. It's actually dropped back into discount. So if we go back to here and check that line, same fund, it's actually in discount, barely, still pretty much break even. But what matters is how it relates to the historical discount. So if we bought it right now at just under break even, meaning there's no, I don't think there's a break even 0 for 0. Maybe there is. There's two. So at no discount, every dollar invested is a dollar spent. Like you're for every dollar invested, you're spending a dollar. So if something's in premium, that'd be 96% premium. It's like paying for every dollar invested, you're actually paying $1.96. And on the flip side, for every dollar invested, you're actually paying 45 cents a share. So we want to buy discount, but more than that, we want to buy exceptionally good discounts. So we notate and specifically mark the parameters. So we want to buy double the historical and greater than the 5-year. And that's the current parameter. If the entire closed-end fund system changed and nothing hit the metric, then we could either leave things the same or we could change our strategy. But a current metric, it doesn't meet the strategy. It is discounted barely. It's like paying it instead of paying a dollar, you're paying let's say 99.7 or yeah, 0.997 instead of a full dollar. But it doesn't meet the metric. So it's just important to know your strategy. I mean, maybe your strategy is just buy the discount. Not so much that it's got crazy discount. Maybe it's just buy the discount. So I mean, price wise, we haven't seen, but dividend wise, it's been crazy. And if this ever spiked back up to $20, the long term question is, what do you just continue to rake the dividend? Like if they leave the dividend the same, do you just continue to rake the dividend or do you sell it? And then in this case, we would transfer out of portfolio. This is our cash brokerage account. So anything we sell in this, we transfer money out and load into here. So same thing. This is our actual portfolio minus the account numbers. So you get our current funds and then kind of our ongoing wish list of things based on the market and what's the best place to be in the market right now. So how does this work? So we take our triples and we plunk them over here. And this used to be everything we're looking at. High fixed income, like bonds, corporate bonds, loans, stocks and tech. But right now, we're really just looking at real estate, and we want consistent monthly payers. So we can screen out these. Now, that's a real estate fund. It's like an off category one. Category one would be 1, 4, 7, 10. This is 4, 7, 10, 12. Has current discount at 8. Yeah, so it meets the metric, but I want monthly payers. I like consistent monthly payers. So maybe on your end of things, it doesn't bother you. I also want a greater than 9% yield unless there's a darn good reason to look at something else. And HFRO is that reason because they cut their dividend when they shifted from an all bond hedge fund to an all real estate portfolio. So at the former dividend, they're well past the 9%. At the current dividend, they are not. The dividend has not changed, but the yield has gone up because the price has dipped. So actually up 2 cents from when we bought it, but the price has dipped. So what else is on the list? Well, let's scale things back to where they were. So that's a straight utility fund. You should have already been in utilities, right? Like if you were going to be in utilities, you should have already been in utilities. Now, you could make a case for this one because it's still underneath its overall average. Utilities are one of those things we're going to always need, but at the same time, it's still cyclical. And currently, in bonds and their proxies, so bonds, utility, and energy are where you should have already been. So if you buy it now, you're going to pay more for it. Also, it's a fluctuating dividend, and you could say it's due for a dividend hike, but it has not been hiked. Uh, let's see, municipal bonds like bonds should have already been there. That's a mix of funds, but honestly, I really don't want to pay $13 for it. We've already talked about that. I get into this almost every video. It's a term fund. So if you buy it now, whenever the term expires, you're getting it for whatever the current NAV is per share. But they're invested in everything oil that also isn't oil. All of these things require oil in order to be made. And yet they don't want to invest in oil because oil is bad. Makes no sense to me. Stocks. One aspect, like if you swing a pendulum side to side, so super small company, but super high fixed income. FSCO is the same way, just on the other end of the pendulum swing and what they manage in assets. MEGI is mostly all utilities and industrials, and it's the same thing. It's uh, if you own it, like if you're looking for utilities, you're late to the battle. So you're going to pay more for it than what you really want to. HOB is a mixed bag. Um, it does have some bonds, but and it does have energy and utilities, but if we bought it for the real estate, we're also going to be buying this other stuff at a higher price than what we want to pay. I want to say when we bought it, it was close to 7 and it's spiked up, which is great. But that just signals that we're late to the party because of these other things in the portfolio. BRW, it used to be straight bonds, but now it's just a mix of things. And I like it. It's a shareholder activist bond fund, and that they want better payouts for shareholders, and they're willing to uh, fight those battles with BlackRock and more. And I like that. But it's kind of the same thing. Bonds are where you should have been, and yeah, you can. I mean, as you invest over time, you're going to get that dollar cost average principle, in the sense of you're going to buy it low and high, and at some point it's going to average out. But at the same time, it's not where to be at the moment. So if we filter all of these things out, quite honestly, the only standout remains HFRO. And the only secondary case you could make is ERH, as because it's really because it's below its average, but you're still going to pay more for it. And the dividend has lagged. I mean, worse than this has lagged in a way. Uh, but I mean, that dividend has been higher. That dividend has been higher. You could make a case for both. So it really comes down to your strategy, one. And two, it comes down to how comfortable you are with the current market. And for us, in general, like if this were 3 weeks from now, like we just bought last week, not going to buy the next week. So we just bought last week. I'll even show that in our portfolio. Where are we? That's here. We just bought this past week, right? Really not much change. We're not going to buy this week. And I am, unless something just like if the bond market just tanks and you have that shock factor felt by those newbie investors and those grain investors, and they sell off as well because they don't want to lose money, and the bond market just goes, then we will reevaluate, adapt strategy if needed, and go from there. But leading up to the election, unless something crazy happens, we're going to sit and see how it plays out, which it's tempting to buy. Honestly, it's always tempting to buy. HFRO is cheap at the moment, and you get this super crazy discount at the moment. But we just bought it. So we're going to hang back and sit and see how it plays out and go from there. So that's really all I have for the week. It's know your strategy, like always. It's know your strategy, know what your approach is, know what you on your end of things, know what your portfolio needs at the moment, but then use the current market towards your benefit. Like I could invest in, like right now, we could buy 100, which we can't buy 100 set. We could buy maybe a 50 set of DSL, but that doesn't meet our strategy in any sense of the, like it's not at a historic discount. It's a monthly payer. I go back and look and see if it's got a 9% payout. Let's see. It's got more than a 9% payout, but it's not a historic dividend. And that's really the key aspect of our strategy at the moment. It doesn't meet that, so it's not going to make the list. We want an exceptional deal, and we're not buying the fad. The herd gets steered, pun, but the herd gets steered into the current fad, and we don't want that. That's investing in where we should already be invested. If the bond market tanks and the herd scatters, well, now the herd's not in bonds anymore. That's probably a good place to be. Now you get to decide on how low you want to let it go before you buy. So it's know your strategy and know how to best optimize the current market in the long term for you. regardless of what you're investing in. At some point, I'm sure we'll get back into stocks. It's just not the best place to be right now. So if we, gosh, with recession looming, so you buy stocks, you actually have the recession, and stocks drop, now you're losing money. I would much rather hold off on stocks and let the recession happen. If it's going to happen, it's going to happen, right? So if we let the recession happen and stocks drop in value, you let them drop and you scoop an amazing deal. And then on the upswing, you either decide if you want to keep it or you sell it. So know your strategy and how that plays into the current market. And then if we pull back and look at just the giant picture of things, like the really ultimate giant picture of things, if we look at our pirate map, I mean, this is the Adaptive Perspective channel, but I also run the Navigate Your Finances page on Facebook, which is moving to Instagram. And um, probably do a different video on that at a different time, but I'm moving my Facebook pages to Instagram under Adaptive Perspective, but it's still going to be Navigate Your Finances. So which might be confusing, maybe I should streamline that. I'll have to look at that. Um, but as we navigate everything, like your ship is on the far left side of the map, your dotted line across the pirate map does not end at Treasure Island. It's just part of the journey. So as you go through that line, you hit one island after another island after another island, like you pay off your crazy debts and you bank in the market and you buy an extra house and you, whatever your dreams are or whatever your waypoints are along the trip, you keep going and there's life to be had after the island. If your life's map is your pirate ship and your treasure island and life does not exist beyond Treasure Island, then you die on the island. And that's not a great plan. And you could be like, what's just a map? Well, map, metaphor, whatever. The reality still, you have no plan for when you leave the island. That's financial death. You gained the treasure. What are you going to do with it? So we have to see the big picture of where we're going. And then that big picture and that map steers and guides everything. The day-to-day finances, the investment finances, our investment goals, what we're shooting for, all of those things so that we know where we exist on the map. You want to be the best you can possibly be at navigating your finances, and that includes how you invest in the market. So you have to have a map. You have to have strategy. You have to have a battle plan of how you're going to go about that. And if none of that makes sense, which it shouldn't, because I've talked about this almost every video, but if none of that makes sense, come find me on Facebook, currently housed under Adapted Perspective, Navigate Your Finances. But very soon, November 1st, my goal is to move everything and start not so much afresh. I already have the Adapted Perspective Instagram channel, but my goal is to move stuff to Instagram and start posting there. So whatever it is that you want to do, like when you look at your map, those dreams and goals and everything else you have laid out in front of you, your hopes, right? The things that you're working towards, when you lay out your map, none of those things will happen on their own. So make them happen. Adapt, overcome, learn, like the whole thing, right? Learn, adapt, grow. Learn, adapt, grow, overcome, change things, right? Don't be afraid of change. Don't get so trapped in what you're doing that you can't think of something else. Something doesn't work, change it, adapt it, twist it, make it work for you. But do not sit on your hands and do not just sit there cross-legged thinking you can manifest everything in thought. I'm not saying you can't think about stuff. I'm not saying you can't plan and you can't dream about stuff or fantasize about stuff. I'm not saying you can't do that. I am saying that none of those things bring forth action. Your dreams will not happen in real life if you do not do anything about them. Sounds like a double negative, but it's not. Or maybe it is, but it turns positive. So in order for your dreams to happen, you must get out there and work and make them happen. Otherwise, they will forever stay in fantasy land. So you make your map and you follow it and you adapt it when you need to. You learn to navigate things better. But there is life beyond Treasure Island. Strike it rich in real estate, strike it rich in the market, strike it rich anywhere you want, right? Have your business blow up and it be amazing. There is life to be had after that. And you have to be ready for it. And if it's not on your map now, it sucks to add it later. It's hard to add it later. Make your map as best you can. You're not going to know everything. Make your map as best you can, right? And then adapt it as you go. Do not reach that island with no plan for the future. Now get out there and make your dreams happen. And I will see y'all on another video. Bye-bye.